Hello and welcome to the latest market update with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. It's been a while, Andrew. How have you been?
It has, yes. I've been quite well, actually. And yourself?
Keeping fit, running, training, doing all that. More importantly, how have the markets fared since we last spoke, Andrew?
Yes, so we didn't actually put out the video last month because we were making some changes to the investment portfolios, which will go live very, very shortly. So now we have probably the last report of the portfolios we've been running for the last few years.
Like we always do, Andrew, travel around the world. We'll start with the UK, close to home. How did they fare last month? Yeah,
so the UK, the Bank of England finally, for 2 months in a row, have now held bank base rate steady at 5.25%. And that's long overdue. It gives the investment world a little bit of confidence that hopefully we're at a high point and that rates will either be steady for a good while or even could start to come down probably into 2024. Investors need confidence and certainty, and so stabilising interest rates where they are is a very, very good thing to do. So that's good news. Inflation remains 6.7%. It hasn't changed for 2 months. The likelihood is probably inflation will start coming down. A little bit of a worry was oil increasing in price because of Saudi and Russian cutbacks. Nothing incidentally to do with the things that are going on in Israel, but oil prices actually started to fall again. So from being a high of $93, then we got down to around about $81 in terms of Brent crude. So outlook for inflation should hopefully fall. Food inflation is still mighty high at a tad under 10%, but the rest of the inflationary pressure seems to be easing a good deal, which is good. Jobs. We're holding steady. Unemployment here is around about 4.3%, which actually in this stage of the economy is not too bad at all, and there are just less than 1 million job vacancies in the UK, so it's actually a fairly good position. The economy, despite the gloomsters, the UK economy is still growing. Many people have tipped it to fall into recession, but just shows how wrong they are yet again about the UK. I don't know, what is it, Dan? Why do we just seem to love bashing the UK economy?
I don't know, because we live here. It's easy.
Yeah. Mm-hmm. Anyway, so yeah, I think the UK generally is looking in a fairly good position, and hopefully, fingers crossed, with a number of strikes now being called to a halt, things are probably going to actually not be too bad at all.
So that's the UK, but what about our good friends over in the US of A?
Yeah, so here it's been, unemployment, again, the rate's at 3.9%, so below where many people think the figures would have been at this stage of the economy. They're putting on slightly fewer jobs, but still it's a good, strong sort of workforce that we've got there. Pay rises are starting to cool a wee bit, which is good. Inflation at 3.9% is higher than it should be, which target's below 2%, but still well less than many countries in Europe and including the UK. But there has been a bit of a cooling as well in the tech side, and some of the big hoo-ha about AI has started to wear off a bit, as people are saying, well, yeah, okay, then AI is perhaps coming, but if we can't see the profits just yet, why are we pricing companies such as Meta and Alphabet so highly on things that are going to be coming down the line? So they've had a bit of a pullback this time. And in fact, when we look at the US, most of our US funds have actually shown negative growth this last month.
So we'll travel back closer to home and investigate the EU. How did they perform?
Yeah, so on the whole, it was a good piece for the European funds we hold. German exports continue to fall, and the German economy technically is in recession as output continues to lag behind where it was this time last year. On the back of weaker international demand, the German economy is a major exporter, and of course suffers then when the rest of the world starts to slow down with not needing quite as much stuff coming from there. Consumer confidence is falling as well, as you would expect, because what's happening is the rate increases, of which there have been many, are now starting to bite consumers. They're also starting to bite companies as well. A lot of companies have debt. Shell, for example, they've got £189 billion of debt, and cost of debt spiralling means that they're paying more for it, which then they pass on to the consumer if they possibly can, or they have their profits squeezed. So Central Europe is bracing itself then for winter. Hopefully we're going to get another mild winter, and it means we don't have many disturbances due to the fact that we're still boycotting Russian oil and gas, although we're buying considerable amounts of the stuff, and lots of stuff LPG as well from Russia. So it's not a total boycott, as many people would like to see, but it's some way towards that. So if we look at unemployment, for example, the German unemployment rate is 5.8%. In France, it's 7.2%. And in Spain, unfortunately, it's 11.84%, with a particular high spot of youth unemployment. I was just going to ask, which country of the major countries around the world do you think has the lowest rate of unemployment?
Lowest rate of unemployment. It's a small nation, isn't it?
It's not that small.
Oh, is it not?
No, I've excluded the really small ones. Like the Faroe Islands, for example.
Well, yeah.
Was the absolute smallest at 0.16.
Well, there you go. See, it's a small place. I knew it was.
Okay, well,
I'm not quite
actually,
sure.
well, I mentioned this only because I may
It's
be
not
going
Australia,
there.
is it?
No, it's close. It's close-ish. Thailand at 1.06% unemployment rate. You wouldn't like to be living in this country if you're unemployed, because their rate of unemployment is even higher than many places in Europe, and the country is. You often get confused with this country. A lot of people say, "Oh, that person in the office, he comes from."
Is it South Africa?
It is South Africa.
I'm not going to do my accent.
No, unfortunately, South Africa.
Oh, you will, though.
32.6% unemployment.
Wow.
That's dreadful. And from back home, Aussie rate of unemployment just 3.6%.
There you go. See, always outperforming. So we've done the EU, America, and also the UK. So we'll pop over to the Far East now, Andrew.
Yeah, so China continues to, I suppose under-deliver, but having said that, their economy is growing, and it is growing at a faster pace than that of Central Europe, the UK, and many other places in the world. But from what we've been used to over previous years, then it's still sluggish. Consumer confidence is weak. We've got a big property crisis there. Unlike many places in the world, especially the UK, they built huge amounts of property, and so much so that they've got too much property and not enough demand, and a lot of the population in China were encouraged to buy property, not only the homes that they lived in, but factories and offices and part ownership, and all very well and good until you find that actually there's no demand for it, and then you come a wee bit unstuck. So China's struggling a wee bit, but although the economy is still growing. Japan's come off the boil a wee bit as well, fallen behind. Other parts of the Far East, though, are experiencing something of a bit of a boom. There's some good growth from many of the countries through there, which is the reason why we're just extending our portfolio a wee bit over there as well. I used wee bit quite a lot there, didn't I?
You like that, yeah?
Yeah, I'm not sure. If we talk about GDP, so the countries with the highest production, we've got the top 6. The US is at number 1 spot, followed by China, followed then by Japan.
Oh, from Japan.
Yeah, followed by Germany, followed by India, which overtook the UK, and then we have UK, and then we have France. So we're beating the French.
So UK still there? There we go.
It is. It's above France, yeah. It's very, very good. That's good. No mention in there of the Australia. But
you must have missed that one.
I think in number 999th position. The conflicts in the Middle East then, well, that hasn't had so much impact as perhaps a lot of people would have thought. And there's several reasons for this. One of them is that really Israel isn't a major economic powerhouse. The other thing is that a lot of the funds and fund managers, etc., expect uncertainty in the Middle East and don't have too much exposure to there. The big thing that we don't want is for the conflict to escalate and involve other countries within the region, because then we get into this very precarious position of, yet again, you have countries that are in charge of a lot of the West's oil and gas needs. And so if these get drawn into it, then we're in real trouble. So let's hope the diplomats can do all they can to sort things out and we get peace as quickly as possible. What we're seeing generally is the effects now of the interest rate hikes that were introduced, what's coming up to 2 years ago, starting to have some effect. And it's the old adage that it used to take around about 2 years for an interest rate change to have any effect, and that's coming good now. So companies are delivering lower growth, profits are coming under fire, but this is all as per expectations. And it's meeting the central bank's expectations that inflation will start to fall down, and therefore the world will be a better place. The difficulty we've got is that over the last 15, 20 years, governments throughout the world have piled so much money onto their country's credit cards, and a lot of the rate of interest that they pay on credit is related to the rate of inflation. So it's very, very important they get inflation down, because then we pay less as countries and as individuals in terms of taxes, and more of that money then can be put to good use.
So to finish up, just looking at our portfolios and how they've performed, I guess. Is it over the last, how many years are we looking at?
Well, what we've done is we've had a look at the usual time periods, and for the first time in a long time, Dan, I'm very pleased to report we have no negative numbers.
Well, there you go. That's good, isn't it?
Yeah, it's a very long time ago that we had that. So that's good. Perhaps things are turning. I think they are. Over the last period then, fixed interest, so lending money to companies, lending money to governments, has started to give us positive rates. They've got a heck of a long way to go, though, to get back to the levels they were at pre-COVID, but we're seeing positive growth from the fixed interest sector for the last wee while. European equities, they've done very well, as have smaller UK companies. And at the beginning of November, actually, the UK FTSE 250 index, which has got the smaller to mid-sized companies, that grew within a week 6.2%. That's the fastest growth period they've had for a very long time, and it made it the world's best performing sector for a short period. The US and also the Far East were the negative contributors to the portfolios.
And as we do with all of our market updates, we'll look at the portfolios and their performance. And we're going to be looking over the last month, the last year, the last 5 years and 10 years. And we'll start, as we always do, with the defensive portfolio.
So this last month, portfolio is up 1.6% over the 1 year period, 2.8% positive, 5 years up 11.69%, and 10 years up 52.32%.
And the cautious portfolio?
The last month up 1.19%, over the year up 2.12%, over 5 years 28.27%, and 10 years up 76.66%.
And the balanced portfolio?
Over the last month positive 1.09%, over 1 year plus 1.52%, over 5 years up 26.06%, and up 10 years 103.54%.
The capital growth portfolio?
Over the last month, up 0.59%. Over the last year, 1.1%. Over 5 years, 30.81%. And over 10 years, 122.34%.
And finally, the aggressive portfolio?
Over the last month, up 0.28%, but still positive. That's what we're taking from that. Over the last 1 year, up 1.22%. Over 5 years, 36.85%, and over 10 years, 144.89%.